Powell made his first public remarks since last week's rate cut. He said stocks are highly valued. Watch this.
We do look at overall financial conditions, and we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve. But you're right. It by many measures, for example, equity prices are fairly highly valued.
I think he is correct in the sense that if you look at the S&P 500 specifically, it trades at 23 times forward earnings, which if you look at historically, it's more like 16 times forward earnings. So you're getting into the later stages of, I would call that tech bull market. Not over yet by any means, but you're getting to a point now where my point is like, man, there's so many places to allocate your capital that's not tech, that's a lot cheaper and pays a lot of dividends. But meanwhile, all the money is still plowing to that tech trade. And I think he is right about that. But that also begs the question, why are you lowering interest rates if financial conditions are actually heating up? I've actually got a problem with that. Like levels since like the 1980s. I think it's a great point. The other problem that I have is the employment market's not falling off a cliff.
It's not.
Right? It's okay, I get we're not hiring right now, but we're not firing. A lot of that has to do with companies are looking for certainty.
Right.
You know, they're kind of like over-indexing on efficiency right now. But at some point, as profits go up, and I always say employment's a lagging indicator. You hire last. And there's a cover of the Wall Street Journal this morning. Bankers right now are poaching other bankers because the market's hot. Employment is not falling off a cliff.
Unemployment is 4.3% last time. That is really almost historically low.
I think we're at a perpetual labor shortage, right? If you have like 4 million people are turning 65 every year in this country. So, you know, basically we have people retiring. Like our industry, you're going to have 100,000 dudes like us retiring by 2035. That's a lot of people that aren't going in the financial services industry. So I think the bottom line is we're in a perpetual labor shortage for a while. It's going to stay tight. And again, I think what we're going to see later this year, or going to next year now, is employment's going to pick up again, and the Fed's going to look like they probably cut a little too early.
Well, I would add one more element here, guys, and that is AI.
Yeah.
Because you're going to see a lot of job losses as a result of AI. What I want to know is what is the plan to replace those with new experiences and new jobs? Because I'm not saying technology is bad, that it's just going to cut jobs. No. I understand. We never knew we need all these engineers. We didn't know we need coders. I mean, we're going to have new jobs. But AI will definitely eliminate jobs.
I actually think it's what we need because we have a labor shortage. We're going to need AI to help us because we don't have enough workers. I think it's the opposite argument. I mean, look, we have the internet for how many decades now, and unemployment's at the lowest rate ever. So I think to your argument, it's going to create new opportunities, new ways to do things. I think the efficiency is going to increase, but I also think it's not going to hurt the labor market like everybody says, because we need workers.